Welcome everyone to our webinar. Apologies for running a couple of minutes late, but yeah, very excited. We talk to our clients a lot about when's actually the right time to buy their first investment property. Comes up in discussions when they're often looking to buy their first property to live in. They want to know what's the goal to aim for, what's the target to aim for when they step into that investment property market. So I'm going to jump straight into it and just take you through and just some idea of the goal of today's webinar is to really answer those questions around when is the right time and the key things that we see, some of the mistakes we see our clients making, and some examples of some clients who we've seen have some big wins in that area. So I'll just start by sharing my screen, but can everyone just put in the chat they can hear me okay? Just if you can just put yes in the chat so that I know the sound's working fine, that would be fantastic. If you can't use the chat, feel free to use the Q&A instead. That would be great. So if you can just put okay in the chat or the Q&A, that would be great. Thank you, Luke. Thank you. Great. Much appreciated. I just wanted to check that. So let's jump into it. Okay, how to know when you're ready to buy your first investment property. So is this webinar right for you? Really, we want to know if you're looking to grow your wealth over time, because owning an investment property, it can be a powerful tool if done well. And if you're frustrated by not getting ahead as quickly as you'd like, certainly you're not alone. We speak to a lot of people in that boat, but you do need to be comfortable with some level of financial risk whenever you're investing, be it property or shares or any other financial instrument. It's always going to be some level of risk, and consequently the return is there for you to be compensated for that level of risk. And I'm going to talk a lot about the holding period for property and how important that is. So I guess one question we ask our clients is, what's holding you back? What is holding you back from making that first step? Is it some sort of external problem where you've got a high cost of living? Is it internal, or about something you've got to work through internally to get comfortable with it? Or is it more around in a world where wages are going up, but not as quickly as property? Is it just practically becoming difficult for you? So some of the common mistakes we see when buying an investment property, very different to buying a property you're going to live in, is that people will still try and purchase on emotion. And if you're never going to live in the property, if it is purely for investment purposes, you do really want to put emotion to the side and get as granular as you can with the numbers and just be focused on the facts and what the numbers say. A lot of people don't accurately take into account the ongoing costs with property and how that can impact cash flow. And obviously that's related to the maintenance and any vacancy periods you experience. A lot of people overcommitting financially. I'll talk more about that, and not getting advice, a professional, when they do make that first step. So there's some supporting data at the moment, and why more and more people are talking to us about investment property is that simple fact is wage growth is not really keeping up with cost of living and property values. So if you're simply trying to earn a good wage and save money, means that you've got to be earning a very large wage to get ahead and be able to save a lot, because asset growth, property growth are outstripping the wage growth, as is the cost of living. So the cost of things to buy for everyday needs is growing faster than wage growth. And there's been several studies around that. So been fortunate enough to be working in this space for over 20 years, and we've helped over 500 clients. We've had several clients that we've helped who have gone on to purchase more than three investment properties and be in a good position to be able to hold those for the long term and not sort of choke themselves from a cash flow point of view. They've bought well, they've done it with some margin, and therefore they've been able to hold them for a long time. So how does it work? Well, the plan is to start with is to assess your financial readiness. So ensure you've got an emergency fund of 3 to 6 months of living expenses. They, the reason we want that in place is if something does go wrong, you've got cash savings to draw upon so that you don't necessarily have to sell assets, but you can keep moving along and hold the property for ideally 10 years. Um, Ideally, 40% equity in your home is what we're aiming for. So if your property is valued at $1 million, we'd like to see the debt at 600,000 or less for your owner occupier debt. And the reason is that the bank will let you access up to 80% the value of your home, and you're going to need to draw upon that for the deposit on the investment property, which I'll explain a little bit in the coming slides. And then once you've done that and you feel like you are in a good position financially, it's then about mapping out the investment property. So identifying high potential locations and then having to think about, are you investing for capital growth over time or more rental income? And usually that is a trade-off. So a property that is going to grow, predicted to grow a lot in capital value, will often uh, be providing a very low rental return. Or alternatively, if you were to buy in a country town out in Western Queensland, you'd see you can actually get yields or rental returns of up to 10%. But those properties from a capital uh, value proposition really haven't done much in a long time. So it's about sort of mapping out which is going to be better for you over at least a 10-year period. And yeah, it's just so important to commit to that 10-year period. But it's impossible to predict, what is going to happen with property values on a year-to-year basis. But obviously, trending over a long term, the trajectory is upwards, and so that's why you want to be able to hold it for a long time, so that you experience that trend of increased value over time. Obviously, you want to have a meeting, ideally with us, to see how the numbers look. So what is it going to mean to hold the property, and what can you borrow from the banks for an investment property? And then, yeah, getting really clear on your long-term plan, what success looks like. And then, consider the alternative if you weren't to act and you weren't to move forward. What does that look like? And having a look at those two options. When you do look to purchase an investment property, these are the three criteria from a bank's point of view that they're going to look at to see if you're in a position to be able to borrow. They're going to look at your equity, which is point A. So if you had a property valued at $1 million, they're going to allow you to access up to 80% of equity, which is 800,000. Now, in that earlier example, if I said if you had a loan of 600,000, that would give you 200,000 to use as a deposit for an investment property. So that's one criteria, having sufficient equity. The second is having the borrowing power to be able to purchase an investment property. They will take into account the future rental income that you're going to receive, but keep in mind too that obviously you're going to be taking on more debt. So the rental income plus any surplus funds you've got left over from your monthly income and expenses will go towards showing that you can afford the loan, and then stability in conduct. So making sure your credit score is sufficient. So do you have an equity? So in this example, the existing home where this that we're living in is $1 million, and the existing loan attached to that property is 400,000. In this case, this individual said, they want to see if they can borrow to purchase an investment property for 600,000, but really they need to borrow 625,000 because they've got to cover things such as stamp duty. Okay, so that is going to be the calculation and the way that the banks would look at it initially, to see if there's sufficient equity. Is they'd add the value of your home, the value of the investment property, then the current debt of your home, and the current debt required for the investment property. And when you put those two figures together, as you do here, so total property value 1.6, and then total lending of $1,025,000, that's got to be under 80%. And that's why I say aim for a 40% equity position in your current home, such as you've got here, because once you overlay that with a new investment property that you're looking to purchase, which more than likely you'll borrow the full amount for, it'll keep you under that 80% and give you some buffer as well. So how would we actually structure something like that? Well, what we would usually do is, again, using the same numbers, rather than just do a loan for 625 and have the properties linked or cross securitized as they are in this example, what we would actually do is separate them out so that you've got your remaining $400,000 loan sitting against your home. And then you take out a small deposit loan of 145,000. Now, how we got to that figure is it's 20% of 600 plus the purchasing costs, such as stamp duty. So 120,000 being 20% plus the 25,000, that gets us to 145,000. That becomes our deposit loan, and then the remaining 80% is secured against the investment property. Now, the reason we do it that way, there's a few reasons. One, but the main one is that it's not linking the properties. So in the future, if you ever sold this property, you'd pay out these loans here. If you sold this property, you would only have to pay that loan out. If you did link them, the bank, when you come to sell, let's say this property, the bank would actually have control of the funds, and they may well use those funds to reduce debt that's associated with this property because they're linked, and that may not be what you want, but they have the control. Whereas if you keep them separate, you're only responsible for the debt that's attached to that property if you sell. And he also gives you the opportunity to use different lenders, which might work out more advantageous from an interest rate point of view. ANZ might have a really good owner-occupied interest rate here, but ING might have a much better investment loan interest rate than ANZ, so you might opt to use them here. The reason I've got these loans in orange is this loan too, despite the fact that it's secured or linked to the house, the family home, it's still tax deductible, and as would be loan 3. So loans 2 and 3 are tax deductible, but loans 1 and 2 are secured against the house. And the idea would be to have any rental income you receive from this investment property feeding into an offset account linked to loan 1, because loan 1 is generally the debt you would try and clear the quickest. So a lot of our clients will opt for interest only on loans 2 and 3, so they can focus all their energies on getting loan 1 paid off as quickly as possible, because at least with loans 2 and 3, they're getting a tax deduction. So the priority is pay down the debt that you don't get any tax benefits from, which is loan 1, and leave loan 2 and 3 and only pay them down once this one's gone. So that's one of the most fundamental core principles when purchasing investment properties. Okay, we're just going to talk about market timing versus personal timing. So as you can imagine, market timing is when you're simply trying to time your entry into the market, and that can be, if done well, can be really advantageous, but very, very, very difficult to do because there's lots of events swirling around the world that we all have absolutely no control over that do have an impact on property prices. And so we much more support the idea of being in the market for a long time and buying when financially it's the right time for you. So I wanted to give you 2 examples, and these are live examples of clients that we've helped in the last 5 years. And the first one is with an executive couple of ours who purchased during COVID, when interest rates were down around, sort of starting to fall. They were down around 2% at one stage, and they purchased an investment property in Queensland. The idea was that they would spend some time there. So there was some emotion attached to it, despite the fact it was an investment purchase. Um, However, once they completed the purchase, and they purchased for about 3 million, just over 3 million, it was about 3,030,000. It was right when interest rates started to really ramp up. And so all of a sudden they borrowed the full amount, $3 million, and then interest rates ramped up, went from about 2% up to 5 pretty quickly. And they found it really difficult to hold the property. And as such, they were forced to sell within about 2-year period. And when you take into account the costs that they paid, the loss was around 250,000. Now, that was about 2 years ago they sold. The property has now gone on to increase by a further 10%, which is about 300,000. So it's up around 3.3. But they haven't been able to capture that growth because they couldn't hold the property. They couldn't afford to hold it. They tried to predict the market, but things played out differently to what they thought with the interest rates ramping up so quickly. And so they've really missed out on a great opportunity. Whereas if they maybe had to purchase something with less emotion, it was a more affordable price bracket, they could have held it and experienced that price growth over time. The second example is a client of mine who's very conservative, but has done very, very well. Purchased his first investment property in 2017 in Brisbane for 530,000. Now, what I like about that is he's bought in a price range that there are a lot of buyers that are in that price range. So it's a very deep market. And he started to pay down his home loan with an income of about 200,000. So a good income, but the property now is valued at 1.1 million. So it's had 13.5% increase per year. Now, because he was focusing on paying down his home loan, his personal home loan debt, he was actually in a position where he bought a second investment property in 2019, again in that price bracket where there are a lot of buyers of 565,000. And that property is now worth 1.36 million approximately. So that one's gone up 23% increase per year. Now that is exceptional and probably not realistic long term. This 13.5% is still very, very good and well above the average, which is more around probably 8 to 10% that you'd expect from property. So a couple of really good examples of buying with emotion, buying where the cash flow is such that it makes it difficult to hold if interest rates go up and things happen unexpectedly, and as such not being able to hold for a long period of time, versus buying conservatively, being able to hold the property for a very long time and being conservative with paying down personal debt so that you can then use that equity that's in your family home to be able to purchase another property. So there's a couple of live examples. I'm going to just share with you one more. This is of more of a case study. So this is what it would look like for this couple over a 10-year period with a couple of different scenarios. So I'll just go through it fairly slowly, but imagine two salaries here, their current home, and remember they've got 50% equity there. You can see a property value of $1 million and a home loan of 500,000. So more than enough equity. And looking to purchase an investment property for 800,000, which even to be able to buy a house in Brisbane now for that is difficult. The average price growth in this suburb, Macgregor, which is near Mount Gravatt, side of Brisbane, over 10 years is 8.14, over 15 is 6.66. So you can see we've had a lot of price growth over the last 10 and even over the last 5 years. So I would always work on the more conservative figure at 6.6. So in this instance, they would use their equity and borrow the full amount to purchase the $800,000 property, add the costs on the rental income. We've just assumed a rental yield of 5% is 770. The repayments on an interest-only basis is that. So you can see it's quite a big shortfall per week and per year. Over time, that will improve because you would expect that the rental income will continue to increase steadily. In other words, the rent will grow and the interest rate Well, it's actually lower than that now. It's more around 6%. So interest rates will go up and down. The rental income should increase steadily over time. So therefore, that position should improve. So if we played that out with a few different scenarios, if we looked at 3.5% capital growth versus 6.5% capital growth versus 8.5 over 10 years. So 3.5 being very conservative. What you see here is that the property value, remember we started at 800,000, at 3.5% over 10 years gets to $1,090,000. Our loan balance hasn't changed because we're making interest only repayments, and our net equity is 255. Now, after the 10-year outlay, in other words, that cost of holding the property, we've still got a net return of 112,000. So we've still got equity of 112,000 that we wouldn't have had, and we've taken into account all our holding costs. And the future cash flows improved a lot as well. It's still only costing $50 a week now to hold the property, assuming that rental income has increased. At 6.5%, you can see the property is now 1.351. Loan balance hasn't changed. Our equity is now 516. Outlays are the same because it's still the same amount of debt, and we've assumed interest rates have stayed at 6.5. And the net return's now 373,000. So that's what we would have if we had borrowed the lot and taken into account the holding costs after 10 years at 6.5%. And then 8.5%, property is now worth 1.667, and our net return after outlay is 688. Now, I have to make it clear what this doesn't take into account is capital gains tax and selling costs. So if you were to exit the property here, you would have to pay capital gains tax on that. Now, we're not accountants, but that'd usually be, you'd be paying tax on 50% of the gain. So you do need to take into account selling costs and capital gains tax. Okay. And I noticed there's some questions in the Q&A, so I will come to those shortly. So there's some high-level numbers of how using debt can work for us if we're getting a growth rate that's higher than the cost of the debt. In other words, if we can get growth at 6.5% and our interest rates are at 6%, then obviously it's growing faster than the cost of the money we borrowed. The other thing that didn't take into account was negative gearing benefits, which are something that can benefit you as well. Now, I do have one question that says, Richard, if buying a home on the Gold Coast isn't feasible with current income, would you consider losing the first home buyer benefits to buy an investment property in a cheaper location until income is higher? Would definitely consider it. I think that's really buying the home to live in is a personal choice. What's your family structure versus renting for your family? If you're on your own, it probably is a little easier to rent in the sense that if you've got to move, it's a lot easier to do than if you've got 3 or 4 kids. And yeah, I think buying an investment property, you're going to get some tax benefits. You're going to be able to be very agnostic with where you buy because you're not going to be living there. So you can really go after some of the best locations. And yeah, that's where you might want to engage the services of a buyer's agent. Buyer's agents have become a lot more popular now, and will basically go and try and locate that ideal investment property that meets the criteria you've got and the price range that you're working within. So that I haven't spoken much about that, but we do have clients now, more and more now, using buyer's agents to help them with property purchases and locating properties. So thanks for the question. Any other questions does anyone have? If you do want to get an idea on your borrowing power, the easiest thing to do, or the easiest way to do that, is simply jump on our website and you'll just go to the home page and simply this book a call button up the top right will take you to a booking link where you can choose a time that suits you to meet. And we usually do that over Zoom because it's quite convenient. Sorry, my internet's quite slow. But yeah, you've got numerous options to book a video call with myself, Kieran, Jack, or Matt, or Andrew. And yeah, you just go down and find a time that suits you with either one of us. And we can take you through your borrowing power very quickly, and you can get a really good high level overview of what you can borrow, what it's going to cost each week, and whether it's going to be right to do that now, or what you need to do to get in a position to buy an investment property. The benefits are there. That definitely holding property, we've seen a lot of clients do really, really well. You've just got to make sure you've got margin to deal with the unexpected. That would be probably my biggest piece of advice. So, any other questions or no? Okay. Well, if that no one does have any other questions, we'll wrap it up there. And please just email me or put a message in the chat if you'd like a copy of the slides, and I can get them over to you. That's no problem at all. Maybe just put it in the Q&A, please send, and I'll send you a copy of those slides. Yeah, more than happy to give you an idea of your borrowing power when the time is right. So, thank you.